Austin.
I'm Aaron.
So energy XLE versus utility XLU. So energy companies are.
Oh, well, the energy companies, they primarily develop and produce crude oil and natural gas, and they provide drilling and other energy-related services. So that can be stuff like actually making the rigs, the drills, drilling the holes. It is not simply just the marketing and the buying and selling of the oil itself.
Utilities are just pretty basic companies that produce, generate, or transmit or distribute electricity or natural gas. Those companies include things like GBA, like up here. NextEra is one that we hold. There's Duke Energy, Southern, and Dominion. Those are all larger companies. So energy.
All right. So some industries within the energy sector, there's actually only two. So I just picked the only two that I could go with. You've got energy equipment services, and these are the guys that are drilling wells. They are making the actual oil or natural gas, basically just energy consumables, harvesting equipment. So they're setting up oil fields or oil rigs, and then they're leasing them out to the companies that are inside the oil, gas, and consumable fuel sector. And these are the people like ExxonMobil and whatnot. They're going to be actually putting their guys out there, collecting the oil, marketing it, selling it, and that's what they do.
Industries within the utilities, so you have electric, gas, and water, and then multi-utilities are companies that do all the above, a mix of them. You have independent power, those are the guys that actually make the electricity, that produce the electricity, and then you have renewable electricity, so geothermal, wind turbines, solar, those are all into that. This is a graph of how it's been performing, so XL uses the blue line, that's utilities. This guy. Underperforming the SPX, same thing with the energy, but hopefully it's on a trend upwards, which kind of makes sense with the recession. Hopefully going into recession. Technical details, so target weight 4.4 of energy, actual weight's 3.9. We're looking for a target weight of 3.5 in utilities, but we actually have 6.6. NextEra is pretty large in our holding. So maybe sell some of that a little bit and maybe put it into energy. Utilities, so big companies, Dominion Energy and Exelon Corporation, those are the two biggest. So utilities are defensive stock. They perform better when the economy is working because people still need lights and power and heat. Special metrics, equipment failure rate. So you want to, if you're going to be a utility company, you need to make sure you have a supply of power, you need to make sure you have a reliable way to get it to customers, and you need to make sure that you actually have some customers. So if your equipment failure rate is pretty high, you're not selling as much electricity because you can't get it to people. This could be, you have to consider things like the weather. If you live in a place where there's going to be a lot of hurricanes, are you taking adequate maintenance precautions? Load and capacity, so how much you're putting through your power lines or your pipeline, as opposed to how much you could. So if you're not at full capacity, you have room to grow a little bit. Maybe they're expecting more growth in the community, so you'll have more people to ship to. So since it's a defensive stock and it's considered safer, you're not looking at big volatility in the price of the stock. So you look at kind of dividend payout ratios, how much are they paying out as opposed to their net income. Debt equity, so maybe they've taken on a little bit of debt to maybe build some new power lines or new pipelines. And then operating margin, it seems to be pretty close across the board, or at least the companies that I looked at. But maintenance expense in those two, if you're only selling the electricity for whatever the government says, you need to make sure that you can get the most money out of that little bit that you're allowed to sell it for. The important PESL analysis is environmental, so carbon emission regulations. It's not going to affect the utility companies so much. It's maybe a trickle-down effect because of the coal power plants. If they're producing electricity, they have to watch their emissions, and so that might transfer into costs to the utility companies. Legal, utility prices are regulated by the government. It's a monopoly, so they have to kind of keep tabs on how much they're charging people. And a political, I was thinking about maybe depending on who is the next president, if they have a push towards renewable energy resources, we might see, a growth in that as opposed to the other coal power plants. So because it's a monopoly, the threat of entry is low. you can only really have one in town. It doesn't make sense to have, it's not efficient to have two power suppliers in town. Also has high startup costs. You have to put in all the poles, you have to put in all the lights, you have to put in the distributor stations. Power suppliers, so whoever they get their electric or their gas from, there's obviously only a couple that you can get that are maybe within reach. You have to find something that's close. So that can give some lack of alternatives. Power buyers is low. We don't really get a choice in who we're going to get our utilities from. So we can't really negotiate prices. Threat of substitutes is also low then, since there's only a single company. You could really go into putting solar panels on your house if you wanted to, but it's pretty spendy to do so. So the rivalry amongst competitors is low as well. Small utility companies can buy them, and you can be a larger distributor, but they'll always have a monopoly over a certain region.
Alright, so within the oil, gas, consumable fuels section, so that is the oil, marketers and producers and not necessarily the equipment, we have Schlumberger Limited. They're $32 billion valued, as well as Energy Transfer Partners. I found out that the energy industries perform well in the late business cycle, which is the one that we are in now, which is a good thing, mostly because of inflationary pressures and the late cycle economic expansion. They aren't doing so well in the early cycles, and we've got a whole recession cycle before that, so it should be a while before, I guess, we get into the early cycle. Some useful metrics. What people are concerned about often is greenhouse gas emissions, and that determines a lot of the regulations that is put on these companies. So that would be like stuff like, these guys are ExxonMobil, they will be watching that, and they will end up with sanctions or higher taxes if their emissions aren't kept in check. I found that leaks per X customers is important. That's kind of just, it's similar to greenhouse gas emissions, just an environmental ratio that's often looked at. But this one's just a little bit more, I guess, useful because it takes per X customers into account, so you can kind of standardize it, as well as barrels per day. That's just how much crude oil is being produced. If it's 1,000 barrels, it's MBBL, and I think 1,000,000 barrels is MMBBL. But that's kind of the standardized metric for just how much oil a particular business or a particular oil field is producing. It's measured in barrels per day. Important economic indicators. Oil prices are obviously very important for the oil and gas industry because, if the prices are higher, they're going to be producing more. They want to get more of that. Taxes, again, they get hit with taxes quite extensively depending on their, and how environmentally friendly they are. There's a lot of political stuff that goes into it, as well as the regulations and just the general global demand for oil. That's important because it could change depending on whether people focus more on renewables or other sources of natural gas, which is in this as well, but I'm mostly focusing on oil. And the key drivers of profitability in this, basically oil prices and how much they can output a day in barrels. Yeah, the price right now for a barrel is around $57. Okay. So some emerging trends that are interesting, a lot of political stuff. Iran has been seizing tankers, and we've been stopping some of theirs. We currently have sanctions on their exporting of oil. They're a large oil exporting country, so basically, ideally, I guess, if the sanctions are working correctly, their oil is not going to other countries and they aren't making money off of it. That decreases the global supply of oil. Qatar is also no longer part of OPEC. They were basically the smallest oil producer in OPEC, but that just gives OPEC slightly less power, I guess. They will continue to produce oil though. Okay, so Porter's Five Forces. Competition in the industry is intense because, there's just a lot of companies that have a lot of money, they're very big, and most of the oil in the world is already owned. Potential of new entrants into the industry, very low. Same reason most oil fields are owned. There's a huge startup to just even get into the business. Power of suppliers is high because it's, almost monopolistic. Oil companies are integrated in every part of the industry. They're basically from the, I mean, it's not like there's separate companies that are giving them the oil, marketing it, selling it. They're kind of just integrated in every part of it, and if they want something to change, they can make that change because they basically run it. And also, you've got to worry about OPEC, which is just a conglomeration of all these like huge oil producing countries. So already on their own, they have most of the oil to begin with. They own the oil fields most of the world, so you can't really, I mean, it's hard to compete with that. The power of customers is low because we need oil, and I guess it's not true that you'd eventually purchase it at any price. However, they don't really, or they can set any reasonable price, and people will be purchasing it because the oil is needed to just make any like modern country run. Threat of substitute products, moderate to low. There's renewables, but renewables can't really make up for the amount of oil that we consume at this time. You'd have to cut back a lot on just about every foot. Okay, so in energy equipment services, we've got Nabors Industries, Transocean Limited. These are companies that produce rigs. They help do exploration into mining and whatnot. They perform well in the late business cycle pretty much for the same reasons. I mean, if the rest of the oil industry, the people that are producing and selling the oil are doing well, these people that help them get there are also going to prosper. So they basically have the same exact business cycle, I guess. Some useful metrics, I could really only find that like rig count is a good one. That is something they often look into, is basically how many rigs are you running where and how much oil is basically left in those areas. Some important economic indicators, oil prices, again, if oil prices are high, there's more people that's going to be wanting oil, they're going to be building more rigs, or they are going to be generally in higher demand in order to keep these things maintained and keep them running. And the key drivers of profitability seems to be hours worked. They are contracted by the hour to build rigs and whatnot. It's kind of just man hours is how much someone will be paying them in order to lease out a rig that they've built in the ocean somewhere. R&D spending, if that increases, if you suddenly find some new technology, say fracking or something to get more oil out of areas where you previously thought that you couldn't efficiently collect anymore, that's going to help a lot. That is going to make you more profitable, as well as increase contracts with more companies that just want more of your rigs. Okay, so emerging trends, natural gas exploration, that again could not really make up for the entirety of like the crude oil that we use, but it is an option and it's something to consider that the energy and equipment services industry can get into. And they do, just not to the same extent as oil. Competition in the industry is moderate. There's a lot of companies that do this, and for the most part, they are just producers and engineers. They aren't really running the whole oil industry like the other companies are, so they are basically just, if you've got a better rig and if you can offer a cheaper price, you get like the contract. The potential of new entrants into the industry also moderate. It's less expensive. I mean, if you wanted to, you could, if you had enough money, go to Texas and buy, say, like just a pump or something, and you could get income from that. And who knows if that would be profitable or a good business venture, but there isn't a whole lot stopping you from just getting into that with just a little bit of makeup. The power suppliers, I would say, is medium. Again, they're just creating these tools that are being used, and really they're kind of at the mercy of the oil companies, which generally have a lot more money, which just actually need these things, and they're probably the ones making the demands. And yeah, the powers of customers are high. The world's largest oil companies, they can make demands. They will say, they basically get to say in whether they're going to lease out your rigs or not. And the threat of substitute products is moderate to low. Again, renewables, who knows if it can actually challenge the current demand for crude oil, or if it will, but it is something to keep in mind. Cool. Questions?
Okay, questions from the class before I start start talking. Okay. Austin, I'll start with your part of the presentation. So for overweight utilities, given where we are in the economic cycle, do you think that automatically is a reason to sell?
Sell utilities, or wait, sell some of the energy, or sorry, sell some of the utilities to put in energy.
So you'd kind of presented this slide and mentioned that we're above our target weight.
Right. I mean, isn't the goal just to keep it within the target range of the S&P 500 regardless? I mean, I think it's a good idea to have utilities, but if you have too much, that'll be negative.
We have a lot of discretion to, like, we're allowed to be, like, it's different for different sectors, but, like, we have like a 10% range on either side for most sectors. Some of the smaller holdings, it might just be 5% on either side.
Oh,
But, like,
so I wouldn't sell it. I mean, NextEra is doing well, that's why it's grown. That's why so much of it, because I was looking at the SIF holding on the website, and it showed a little bit different numbers than the one we got printed out in class. It's grown in share price, so that is increased our standing, right?
yeah, so if, for example, NextEra performs better than the overall SIF portfolio, then it will become a larger percent of our portfolio because it's appreciated more, right? Okay, so just something to think about when you're thinking about the target weight is maybe not automatically say, well, we're overweight, so this is a good time to sell, right?
Yeah.
Trends in the utilities sector. Do you think there's anything that your pestle analysis might have missed?
Like
I mean,
in
there's a similar
California.
trend. Sorry?
California.
Oh, what's happening in California?
What's happened with utilities in California last year?
Like-
Anything
They
worth
run out of
noting?
water.
What?
Didn't they run out of
Well,
water?
they burnt the state down.
Oh, with the big, yeah, there was a lot of companies that got in trouble, you're right.
PG&E just filed for Chapter 11 bankruptcy, and I think they're the biggest utilities provider in California.
Maybe they're not a good idea to invest in. California is complicated, I feel like. I haven't looked into specifically what happened in California, but I feel like for the most part, utilities are a pretty safe bet, but that doesn't, whatever problems they had are definitely something to keep in mind for other utility companies.
So I'd say this isn't like a fast-moving, crazy sector. You have the time to do the analysis. I would sit down and read about PG&E because it's certainly not the first utility to declare bankruptcy. It's happened before, so even though this is people view utilities as fairly safe bets, their profit margins are oftentimes set through regulation, so they have a limited amount of wiggle room, so they're oftentimes pressured to keep their costs low, and it may result in them cutting some corners and not taking the safety precautions they should, and ending up with lots of lawsuits when a huge swath of the state burns down,
Yeah,
right?
that'll do it.
And it's not just California, so I would look at PG&E and think about that, think about risk, and some of the particular challenges of having a business model like a utility, where you have somewhat limited upside and a lot of government regulation in terms of how you set your prices. So, Aaron, I was a little surprised I didn't hear the word commodity at all
Oops.
during your section. Okay, a few things I might add to your metrics list. So you talked about BBOE, billions of barrels of oil equivalent, which is oftentimes how they look at liquefied natural gas. They also use BBOE for oil itself. Produced per day, proven and probable reserves. So how much oil is in the ground that oil company has access to. And then it's worth noting that there are, while the big oil companies are what we call integrated oil and gas companies, like your BPs and Chevrons of the world they both go out, discover oil, drill for that oil, refine that oil, and then sell it at a pump. There are lots of companies within the oil and gas world that only focus on one aspect of that. So not all companies are integrated.
Gotcha.
In which case they would, if you just refine oil and sell it at a pump, but you don't go actually out and drill for it and explore for it, you have a very different risk profile. You also have a different set of suppliers because you're buying oil off of someone as opposed to finding it yourself.
That's called upstream, midstream, and downstream. Just like keywords when you want to look it up.
And also a clarification that a lot of people have trouble with in Five Forces. There's a difference between suppliers and competitors. Suppliers are the people who are selling you stuff. So if you're looking at oil and gas companies, like an integrated oil and gas company, they are not suppliers in that sense. You're doing a Five Forces of their industry. The suppliers are maybe those specialized service companies that they hire to do certain things, maybe the equipment manufacturers that make specialized equipment for them, but they are not suppliers. So think about that when if you ever want to retool your Five Forces there. You talked a lot about OPEC. How much of the world's oil does OPEC represent, like the oil production from last year? Any idea, a rough ballpark?
Not sure. I know they own 70% of like the oil, I guess, proven oil reserves on the planet, but I don't know how much of it they're actually like pulling out.
I think they've tapered back on production, like they could pump out a lot, but
I mean, that's the whole point of a cartel, is they don't just, supposedly they shouldn't just be flooding the market with oil, they try to keep prices high. The US is now one of the largest exporters of energy, right, of oil, right? So, that's something to think about in some of those dynamics, and when you're thinking about trends in the industry. I also didn't really hear you talk much about like fracking or some of the technological changes, and it's something to think about as well. R&D spending for the equipment industry. I think R&D spending would probably, well, it could be relevant, maybe or maybe not, if you're talking about very specialized equipment manufacturers.
I was more talking about like exactly like fracking there. Like if you spend the time and money to research that technology and it works like it has, then you're going to be pulling far more oil out, and that is like an indicator that I guess you're going to perform better.
So-
if you're like developing new technologies to.
I'd again kind of try to make sure you're keeping clear on which industry you're looking at, because you started talking about that when you were talking about the like equipment and services sector or industry. So who's developing the R&D for fracking, right? Like, think about that.
I'm not sure.
It's probably one of those integrated oil and gas companies,
Okay.
so different industry. So just be clear about like what you're analyzing when you're analyzing it, because there is some overlap, right? Industry lines are sometimes a little blurry, but just make sure you have a clear idea of like the actual industry you're really talking about when you're talking about it. And general advice on presenting: make your slides a little more visual. I recently, or like I sat through a training and people taught, one of the outcomes from this training, or something that I took out of it, which was something I kind of knew, but just I thought it was interesting the way they phrased it. Apparently the part of your brain that processes visuals consumes like less energy. Basically humans have evolved to really like visual things. So make things visual. We don't like reading a lot of text. It hurts our heads after a while. Okay?
I have a random question.
Sure.
On that chart, I mean, I was looking at how just the price